Good morning and welcome to the Monday 30th of November Smart Financial Planning Review of the Weekend Papers. Today I'm going to look back on a subject that I covered earlier in this year, and that's the merits of investing in gold. The weekend's papers have been full of suggestions of how you can invest in gold, why you can invest in gold, why countries are starting to buy gold again, why institutional investors are starting to buy gold, and why therefore as a retail investor this would seem like a sensible thing for you to do. I have a few pieces of information for you to consider. The price of gold in dollars in 1900 was approximately $20. If you revalue $20 in inflationary terms, so what was the spending power at the end of 2008, that equates to $503. And the price of gold at the end of 2008 was actually just over $600. So over 108 years, gold as an investment has managed to outperform inflation by about a fifth, by about 20% over that time period. And the reason for that is quite simple. Gold, like the vast majority of commodities out there, will, given a long enough duration, perform only in line with inflation. Because commodities in general are the constituents that form the building blocks of the products that companies make and therefore sell on to the rest of us. So it's fundamental that commodities will perform in line with inflation over long periods of time, and this has been very definitely demonstrated with these figures. In the short term, anything can happen. So in the short term, investing in gold has been a fantastically good thing to do. When I visited gold earlier in the year, it hadn't been a good thing to do from the position between the turn of the year and when we looked at it, because actually investing in the stock market would have been a much better thing to do. But at that point, you were looking at it as, is this genuinely a way to invest and make money? And the answer in that period was no. And the question I posed at that time was, does it perform a good job as a hedge against the volatility of the stock market? The answer to that question is still no. What it does do is deliver over very long periods of time broadly the returns of inflation. So you put your money in, you put it away for a long time, and when you take it back out, you can buy exactly what you could have bought with it the day you put it away in the first place. There are very few of us make investments with the intention of simply keeping pace with inflation. The main reason for that is usually we can beat inflation simply by putting our money in the bank, and that's the case today. If you were trying to beat inflation, and inflation is arguably zero at the moment, you would put your money into the bank, you would keep that money there for a period of time, you would get a return in excess of the inflation, pay your appropriate taxes, and you would have made money. So in the long term, despite what the papers tell you, despite how attractive it looks over short periods of time, and I'm sure I don't need to remind you about the variety of things that looked very attractive, like technology for example, in the past over short periods of time, gold is a way to hedge inflation over long periods of time. As investors, you're usually looking to beat inflation, and as such, gold doesn't now, didn't 6 months ago, and didn't 50 years ago form a part of that type of investment portfolio. That's us for this week. Look forward to speaking to you next week.